Let's take a look at something really interesting today, the growth paradox happening at central finance.
So get this, how does a company manage to almost double its lending in just 6 months, while at the exact same time its number of bad loans gets cut in half? I mean, that seems to defy financial gravity, right? That's the puzzle we're going to unpack. So how on earth did they do it?
Okay, quick but important disclaimer here. This is fundamental analysis for educational purposes. It is absolutely not financial advice. Right, let's get straight into the two numbers that are at the very heart of this paradox. First, let's talk growth. In just the 6 months ending in the first half of 2025, their loans to customers shot up by 94%. Think about that. It jumped from about 9.5 billion rupees to nearly 18.6 billion. That is just an explosive rate of expansion.
But here's where it gets weird, the big contradiction. Over that same high-growth period, their percentage of problem loans, what the industry calls growth stage 3, didn't go up. It got cut by more than half, dropping from 3.79% all the way down to 1.76%. Logically, you'd think with that kind of crazy growth, risk would be going up, not down. This is what we need to investigate.
So, where did all the fuel for this 94% expansion even come from? Well, the answer is in two places, a really powerful profit engine and a major strategic pivot on their balance sheet.
If you look at where their profits come from, you see a key strength. Yeah, their core lending is doing great. Net interest income is up 12%. But look at that other slice. Over 30% of their pre-tax profit comes from their associate company, Nations Trust Bank. That gives them this powerful and really consistent earnings base to build on.
And this chart shows the real secret to their expansion. Because while profits were good, profits alone could not have funded this kind of growth. What the company did was make a huge strategic pivot. Their borrowings absolutely exploded, going from just 4.4 million rupees to over 4.16 billion. This is where the cash really came from.
Now, this brings us to a really important metric called the loan-to-deposit ratio. It's pretty simple. It just measures how much a company is lending out compared to the deposits it's holding. If that ratio is over 100%, it's a big sign that they're using other sources of cash like debt or equity to fund their loans.
And central finance's ratio? It's a whopping 183%. This just confirms their strategy. They are not just sitting back and relying on customer deposits. No, they are aggressively using their balance sheet, funded by their shareholders' equity, and, like we just saw, a massive injection of new debt.
So they clearly have the funding to grow, no question. But that brings us right back to those unbelievable asset quality numbers. You have to ask, is it too good to be true? And this is where we have to talk about something called unseasoned risk.
This quote really nails the analyst's point of view perfectly. See, when you write a new loan, it almost never goes bad on day one. It takes time, right? It takes time for any problems to actually show up. And because their loan book doubled so incredibly fast, the vast majority of these new loans just haven't seasoned yet. The real test of their quality? That's still coming.
Now, while that unseasoned risk is a really big deal, you have to know that this company has some powerful defenses. To get the full picture, we have to look at its incredible capital position and a sort of hidden strength in its cash flow.
And here's the crucial point. This company is a fortress. Its total capital ratio is sitting at over 38%. That's nearly 3 times the regulatory minimum of 14%. This enormous cushion is exactly what gives management the firepower to absorb any potential losses from those new, unseasoned loans and even think about growing more.
And check this out. This is a detail that most people miss just looking at the income statement. While the P&L reported 2.31 billion in profits from its associate, the company actually received 2.77 billion in cold, hard cash dividends. Anytime the cash you get in the door is more than the accounting profit, that is a huge signal of exceptionally high-quality earnings.
So, when you put this all together, what's the final verdict? Well, for me, it all boils down to 3 key strategic takeaways.
First, there's the associate trap. With 30% of your profit coming from one investment, Nations Trust Bank, the health of that single company is absolutely critical. Second, that unseasoned loan risk we talked about. The huge question mark is still hanging over the quality of that massive new loan book, and we'll only see the real answer in the coming quarters. And third, what I call capital optionality. That fortress-like balance sheet gives management a massive choice. Do they double down and grow even more aggressively, or do they start returning some of that excess cash to their shareholders? So the bottom line is this. Central Finance is making a very clear, very deliberate pivot. It's changing its entire identity from being this conservative, overcapitalized fortress into a much, much more aggressive growth engine. And it's using debt to light the fuse.
And that really leaves us with the final big question. In this transformation from a fortress into a growth engine, has the company actually found the right balance between risk and reward? The numbers today look incredible, but the real answer? Well, only time's going to tell that story.